Forget everything you thought you knew about the silver market because the game has fundamentally changed, and the $100 mark is no longer a fantasy, but a battlefield. While casual observers were distracted by the daily noise of the stock market, silver has quietly undergone a violent structural shift that is pushing the Western paper trading system to its absolute breaking point. We are currently witnessing a historic tug-of-war between a massive physical deficit and a desperate paper market trying to keep the lid on prices, but the math simply doesn't add up anymore. Analysts are now warning that the upcoming delivery dates on the COMEX could trigger a force majeure event, a scenario where the exchange literally runs out of metal to hand over to buyers. If you are holding physical silver, you are sitting on one of the most strategic assets of the decade. If you are sitting on the sidelines, you are watching the fuse of a global supply explosion get shorter by the second. Welcome back to Money Stalker, your primary source for aggressive, deep dive analysis into the precious metals markets. Today is February 26, 2026, and the silver market is currently standing at a massive crossroads that every investor needs to understand. In this video, we are breaking down the latest spot price movements that have seen silver retreat from its 3-week high of $91 down to the $87 level. We will analyze why this pullback is actually a healthy consolidation in a monster bull market. We are also diving into the critical supply-demand data, showing that we are now in our 6th consecutive year of a global silver deficit. Furthermore, we will examine the shocking reports coming out of the COMEX, where delivery demand has surged to nearly 100%, potentially exposing a mathematical collapse of the paper-silver system. By the end of this update, you will have a clear, data-driven picture of why silver is transitioning from a speculative trade into a critical, strategic resource. The current price action we are seeing this week is a perfect example of the volatility that defines a price discovery phase. Just yesterday, silver was testing the $91 resistance level, only to pull back toward $86 and $87 today. This retreat is being fueled by two main factors: easing geopolitical premiums as U.S.-Iran talks show potential progress in Geneva, and a resilient U.S. dollar following sticky inflation data. But do not let the short-term red candles fool you. The underlying fundamentals are more bullish than they have ever been in modern history. Even with this pullback, silver is still up significantly for the week and has maintained a staggering 180% gain year-on-year. What we are seeing is profit-taking from traders who are nervous about the new global tariff plans, which could see duties rise from 10 to 15%. This creates a temporary wait-and-see atmosphere, but the physical reality of the market is far more urgent than what the tickers suggest. Let's talk about the physical deficit, because this is the heartbeat of the silver bull case. For 2026, the market is projected to face a shortfall of at least 67 million ounces. This isn't just a one-time blip. It is the 6th straight year where the world has used more silver than it has mined. We are now at a point where above-ground inventories have been largely depleted. JP Morgan Global Research has updated its outlook, projecting that the total physical deficit could actually reach 245 million ounces when you factor in the explosive growth in industrial applications. Silver is no longer just poor man's gold. It is the backbone of the green energy transition and the AI revolution. The solar industry alone is breaking records, with new N-type cell technologies requiring up to 22 milligrams of silver per watt. As the world aims for 750 gigawatts of solar capacity this year, the industrial demand floor for silver is effectively ironclad. While industrial demand is the floor, the COMEX delivery crisis is the ceiling that is about to blow off. This is perhaps the most critical news for February 2026. Tomorrow, February 27th, marks the first notice day for March silver futures. Historically, only about 3 to 5% of futures traders actually want the physical metal. The rest just settle for cash. However, internal data suggests that delivery demand has recently shattered these norms, surging toward 98%. The problem? The COMEX has approximately 98 million ounces of registered silver, while the contracts tied to March delivery represent over 400 million ounces. We are looking at a 4-to-1 ratio of paper promises to physical reality. If these large institutional players continue to demand metal in hand instead of paper in the pocket, the exchange will be forced into a cash settlement or a declaration of force majeure. This would be a psychological catastrophe for the paper market and would likely cause the physical price to decouple violently from the screen price. We are also seeing a massive geopolitical shift in how silver is handled. China, which controls roughly 70% of the world's refined silver output, has officially added silver to its rare earth export control list as of January 2026. This is a strategic move to ensure their own domestic solar and electronics industries have the materials they need, but it effectively chokes off the supply to Western markets. At the same time, we are seeing tech giants like Samsung bypass the public exchanges entirely. Recent reports confirm that major technology firms are signing exclusive offtake agreements directly with Mexican mining companies. When the biggest consumers of silver stop trusting the London and New York exchanges to provide their supply, it tells you everything you need to know about the perceived stability of the current system. They are voting with their billions, and they are voting for physical custody. On the investment side, the silver ETFs are telling an interesting story of strong hands versus weak hands. In January, we saw a massive liquidation in the iShares Silver Trust as the price touched record highs near $120. Many retail investors were shaken out by the 30% Black Friday crash at the end of the month. However, so far in February, we have seen a reversal. ETF holdings are growing again, even as prices consolidate. This suggests that institutional dip buyers are moving in to replace the speculative retail money that was flushed out during the January volatility. This changing of the guard usually precedes a more sustainable and powerful leg up in the price. The gold to silver ratio is also hovering around 58, which is remarkably low compared to the historical average of 80. But many analysts believe that in a true supply squeeze, this ratio could compress toward 30 or even 15, which was the historic monetary standard. What does the expert commentary tell us for the rest of 2026? The consensus among top-tier analysts is that we are in a high-price, high-volatility regime. Citigroup is looking at a target of $100 by next month, while more aggressive bull cases from Bank of America suggest that if physical tightness persists, $150 to $170 is a credible scenario within the next 18 to 24 months. Even the more conservative banks, like Goldman Sachs, who were previously calling for a return to $30, have been forced to revise their estimates upward to the $75 to $85 range just to keep up with the industrial demand curve. The message is clear. The days of cheap silver are over. The combination of declining ore grades at major mines, rising environmental compliance costs, and the absolute necessity of silver in modern technology has created a perfect storm for the bulls. Technically speaking, the $80 level is now the line in the sand. As long as silver stays above $80 on a weekly closing basis, the long-term uptrend remains perfectly intact. We are currently building a massive cup and handle pattern on the long-term charts, and a breakback above $100 would likely lead to a parabolic move as the shorts are forced to cover in a market with no available physical supply. This is not just about a chart. It is about the math of exhaustion. You cannot print silver, and you cannot run a modern economy without it. Whether it's the U.S. government's Project Vault trying to stockpile strategic minerals, or the massive short positions on the Shanghai Exchange being squeezed, every indicator is pointing toward a monumental revaluation of this metal. In summary, the silver market is currently digesting its massive gains from late last year, but the structural foundations are stronger than ever. We have a relentless industrial demand driven by AI and solar, a 67 million ounce deficit that isn't going away, and a COMEX system that is running dangerously low on the metal it promises to deliver. The current dip to $87 is not a sign of weakness. It is a gift for those who understand the long-term trajectory. We are moving toward a world where silver is recognized as a strategic asset of the highest order, and the paper markets are about to find out exactly how much a physical ounce is worth when nobody is willing to sell. If you found this deep dive into the silver market valuable, make sure you hit the subscribe button and turn on all notifications. Here at Money Stalker, we track the data that the mainstream media ignores so you can stay ahead of the curve. What is your price prediction for silver by the end of March? Do you think the COMEX will actually declare force majeure, or will they find a way to paper over the cracks once again? Let us know your thoughts in the comments below. Don't forget to like this video to help us reach more silver stackers and investors. Stay focused, stay disciplined, and we will see you in the next update.